Hi. In this session, I'd like to take a look at venture capital, a VC for short, and how venture capital is attached numbers to companies. For instance, a few months ago when I valued Uber at $28 billion, as many of you know, Uber had been priced at $62.5 billion in its most recent venture capital round. The question I was often asked was, how come your value is so different than the value attached by venture capitalists to the company? And my response threw a few people off. I said venture capitalists don't value companies, they price them. And in this session, I'd like to talk a little bit more about why venture capitalists price companies and why I think it is their competitive advantage, the edge that they use to separate the elite from the not so elite. So let's set the table up. This particular session, webcast, was triggered by a Wall Street Journal article, and like many of my posts and webcasts are. And the Wall Street Journal article had a headline that said Andreessen Horowitz, one of the VC elite, a big name VC company, had trailed other elite VC firms. So I was drawn in. I mean, you're always drawn in when you see a big name and the word failure in the headline, as this one did. And I have to tell you, I was remarkably unimpressed by the article, because here's what it did. It took three funds run by Andreessen, and the funds are very creatively named Fund 1, Fund 2, and Fund 3, and compared them to the top 5% of all VC returns. And to compute the returns on Andreessen, the journalist did what you usually do. You add the realized returns, which is the returns you've already made on your VC investments, with the unrealized returns to come up with an internal rate of return. And he compared that internal rate of return and came to the conclusion that these funds were not as good as the elite. Now, the reason I wasn't impressed, if you look at the returns on these funds, they're 25%, 27%, and 42%. Now, if I made a 25 to 42% return over this time period on any investment, I'm not complaining. I mean, that's a little bit like saying Kevin Durant had a horrible season last year relative to LeBron James and Stephon Curry. But that's going nowhere. So the article, I felt, oversold itself, but it must have triggered a response because Scott Kupor, who works at Andreessen and one of the VCs I most respect, wrote a long blog post on what he thought was wrong with the Wall Street Journal article. And he attacked it on two bases. The first, he said, was that the journalist was combining realized with unrealized returns. Now, this is how journalists actually compute returns for mutual funds and public investors. You take the returns you've already made in the form of dividends or cash flows or what you've already sold. But if you have investments on your portfolio, you look at what the market price of those investments is today to compute what the unrealized return is. So the journalist had done what he usually did with other investments to a VC, but Scott pointed out that unrealized returns for a venture capitalist, unlike unrealized returns for a public investor, were not returns you could monetize easily. They're not based on market prices, they're based on estimates. And those estimates are often driven by what other VCs are paying for similar companies. And he went on to explain how VCs attach prices to companies. Implicit in the argument he was making was there's a lot more noise in unrealized returns, and therefore you can't count them the same way you do realized. And implicitly, he was also saying that different VCs can bring in very different estimation procedures, and there's a potential for bias. I read the article, and there was nothing in the article I disagreed with, but I thought it might make sense to provide an outsider perspective on what exactly is going on inside this glass bowl that is VC investing. So here's the way I approach the process. In post before and webcast before, I talked about the contrast between the pricing process and the value process. We spend a lot of time on the value process in classrooms, in my books, in my posts, and we know what drives the value of a business. It's cash flows, growth, and risk, and we use discounted cash flow valuation as a tool to estimate value. Now, the pricing process is driven by demand and supply. You're saying, well, shouldn't price be equal to value? Perhaps in an efficient market. But demand and supply can deliver a very different number than the value process. And we know from behavioral studies and from looking at markets that the pricing game, in addition to being driven by fundamentals, I'm not going to say they don't matter, is driven by mood and momentum and all those factors we think about as driving markets. It's a lot of incremental information, small pieces of information driving markets, liquidity. And if you look at the tools for pricing, it's not discounted cash flow valuation, it's multiples and comparables. And if you really were honest about the pricing process, you could, if you're trying to detect shifts in mood and momentum, even look at charts and technical indicators. There's the pricing game and the value game. And my basic argument has always been that VCs really play the pricing game. And what do I mean by playing the pricing game? If you look at how VCs attach numbers to companies, there are three fundamental ways they do it. The first is to look at a recent pricing of the same company by another venture capitalist. So as an example, if you were invited to invest in Uber right now, the most recent venture capital investment in Uber was by the Saudi sovereign fund, which priced Uber at $62.5 billion. That becomes your baseline price. It might not be the price you attach today. You might have to pay a slightly higher or a slightly lower price, but that becomes your benchmark for what the pricing of the company is today. And this is not just for new investors coming in, but for any existing investor in the company. This becomes a way of marking up your investment. So if you're an early venture capital investor in Uber, you would mark up the pricing of Uber on your portfolio to reflect the Saudi investment in Uber. So you're basing your pricing on what others are paying for the same company. The dangers, of course, are manifold, right? You're looking at one company and one investor, so you could have one really bad investment trigger a repricing across the board. A slightly more expanded version of pricing is to look at the pricing of other private companies. So what you do is you take your private company and you look at similar companies in the same space. And already you can see the opening for subjective judgments, because what's similar, that's up to you to decide. What's the same space? Are there gaming companies? Are there social media companies? Are there online advertising companies? So you find similar companies in the same space with all the subjective judgments involved. You scale the pricing of each of those companies. So if you've seen transactions, what other people are paying for those companies, you scale those prices to some common metric. What am I talking about? If you're looking at ride-sharing companies, you might look at the prices that people are paying for Uber and Didi Chuxing relative to the number of riders, or the number of drivers, or the number of cities, or if you're a social media company, the number of users, and you apply that pricing metric to your company. So if people are paying $100 per user for other companies in the social media space, and you have 10 million members or 10 million users, 10 million times 100 is $1 billion. That becomes the pricing of your company. Now, in some very specific cases, and this is uncommon, if your private company has substance to it today. What do I mean by substance? It has revenues, even making earnings. You could borrow from public companies in the space. So if you're an online advertising company and you have $1 billion in revenues and $100 million in earnings, you could take what public companies in the online advertising space are trading for. Let's say they trade for 3 times revenues, and apply 3 times revenues to $1 billion in revenues, and you got the pricing for your company. So in summary, you can look at the pricing of your company by other venture capitalists, the pricing of similar private companies, or pricing of public companies. There is one extension of the last approach that's worth thinking about. I told you that if your company has sufficient substance today in terms of operating numbers, you can apply a multiple based on public companies today. But most small companies, most young startups don't have much substance today. So one solution that venture capitalists adopt is they forecast out the revenues or earnings 2, 3, 5 years out. As many years as you have to go out to get some substance in the number. So let's say your expected revenues in 5 years are $1 billion. You apply a multiple to those revenues based on what investors are paying in public companies for those. So let's say that investors are paying 5 times revenues. You apply 5 times $1 billion. You got $5 billion. But that's in year 5. You have to bring it back to today. To bring it back to today, use what's called a target rate of return. What's the target rate of return? It's a number. It's your receptacle for your hopes and fears. In addition to reflecting the ongoing risk of the business, this is where you reflect your fear that your company might not make it. Remember, a lot of young startups don't. Or that it'll burn through cash and have to go out for fresh capital, which dilutes your equity holding. And you pump up your target rate of return to reflect those. And what you get as a present value is the pricing of your company today. So essentially, it's an extension of the third approach of pricing based on public companies, but it's just pushed out forward, but it's still a pricing. So here's the issue, though. Everybody prices companies. Public market investors do, VCs do. So you're saying, why are you picking on VCs? I'm not. But VCs face a statistical problem. If I'm a public market investor and I'm using PE and I'm pricing companies based on PE, let's have an oil company. I have 350 publicly traded oil companies just in the US and more than 1,000 globally. A VC pricing a ride-sharing company is lucky to find 10, and so the sample size is much smaller. And within that sample size, you don't get trading every minute of every day like you do on most public companies. You get transactions once every 3 months, once every 6 months, so there's infrequent updating of the prices. And finally, the transactions themselves are opaque. What do I mean by that? If I told you a VC paid $50 million for 5% of a company and asked you what the value of the company is, your reaction, that's easy. If you paid $50 million for 5%, the company is worth $1 billion. If only it were that easy. VC investments have options embedded in them. Some of the options are designed to protect the VCs from dilution. Some of the options are designed to give the VCs special prices on future capital raising. Those options can alter the value of the company. And it's easy to do, actually. You can take a $600 million company, take 5% of the company, and rather than have to sell it for 30, sell it for 50 if you can add enough options to the mix. And the way this shows up is if I showed you VC pricings of other companies, you can't just extrapolate from the pricing. You got to clean up for the options embedded in these VC investments. So small samples, infrequent updating, opaque transactions, you have a statistical problem. So what, you might ask? Well, there are logical consequences. In fact, given the small sample size, the infrequent updating, and the fact that the observations are opaque, here's what I'd expect to see. I'd expect to see more error in VC pricing because, in a sense, it's a statistical problem. You should see it as a larger error, a larger band around your estimates. The second is, given how much subjective judgment I allow you to make about what you define as similar, what the same space is, when you do your forecast, there's room for far more bias in VC pricing than there is in public market pricing. The third is the pricing will lag the market in the VC business, and here's why. If you're pricing based on VC transactions, we know, given history, that VC transactions ebb and flow. In good times, there are lots of transactions. In bad times, they can dry up. Like in the aftermath of the .com bust in 2000, a lot of VC transactions were pulled off the table. And when transactions stop, sometimes repricing also stops. And the way this will manifest itself is if you look at the returns reported by VCs, they will lag the market by a quarter, maybe even a year, if there isn't enough repricing being done. There's also a possibility of a price feedback loop. It's always a problem with pricing, but in VC pricing, one bad transaction can hijack an entire process. So all you need is a few people starting to throw money around, and you can get the pricing process very quickly get out of control in either direction. And finally, there's a time horizon issue. As I said, monetizing a pricing win in public markets just means going to the market and selling your share. It's not that easy in the VC business. Not only do you have to take a position in an underpriced company, but you've got to build up the company and find somebody who will then find it attractive enough to take it off your hands at a much higher price. This is what I think Scott's talking about when he describes VC as the long game, not the short game, is you have to sometimes have patience. Now, you'd think with all this noise and trouble with VC pricing that this would be a problem, but I think it actually turns out to the advantage of VCs, because if you look across time, and this is not supposed to be a final judgment on VC returns, it's a very rough assessment of VC performance. If you compare VC performance to the performance by private equity investors in the S&P 500, kind of as a proxy for public market investors, VCs have done much better than public investors. In fact, barring that 15-year time horizon where you're catching VCs at the peak of the .com boom and they've not been able to make up for it, you find that in almost every time period of history, VCs have done better than public market investors. So if you look at the blue line, that's the VC return. The gray is the S&P 500. And it's very difficult to find a time period where VCs have underperformed. So the VC performance is pretty interesting. It's clearly they are able to do something, bring an advantage, something to the table that public market investors are not. There's an added layer in the VC business that you don't see in the public market. In the public market, the elite investors, the people who do really well in each period, don't seem to have much consistency. In the VC market, they do. Elite VC investors seem to be able to hang in there for longer periods and deliver higher returns for longer periods than public market investors. So the question is, how do you reconcile these two findings? If VC pricing is more noisy and more subject to bias, how is it possible that VCs are able to beat public market investors and the very best VCs are more consistent than the very best public market investors? I think the answer lies in the troubles that we pointed to in the pricing problem. I think the elite VCs bring three big advantages to the table. It's true, everybody in the VC game prices companies wrong. It's the nature of the process. It's no one's fault. But there's a saying I use in class all the time that sometimes gets me into trouble. But I say, you don't have to be right to make money. You just have to be less wrong than everyone else. And I think that's a quality that VCs draw on. They don't have to be right. They just have to be less wrong than everybody else. And everybody else in their space is making such big pricing errors that if you're a little more precise than everybody else, you walk away with an advantage. The second is VCs are not just passive investors, right? They don't buy something that's underpriced and hope to just sell it when it gets overpriced. They get to influence the game. In a sense, they both play the game and they're referees in the game because they can take a position in the companies that they invest in, give advice to the managers on the pricing metrics they should be focused on, help them pump up the metrics, and get them out into the market at exactly the right time. So in a sense, they can influence a game. And finally, all pricing games are about timing, getting in at the right time, getting out at the right time. And I think the very best VCs are better at timing their entry and exits into VC investments, and that shows up as better returns. So what's the bottom line? VCs price companies, they don't value them, but that's not a critique. That's what allows them to deliver the returns that they've been able to do. And it's in fact exactly what you should expect them to do given the way we measure success in this business. That's about it. I hope you enjoyed this. Thank you very much for listening.